Hey there, guys. Jared Boyd here from Blue Wealth. Today, I just want to quickly explain the risks that people face who are approaching retirement and the ones that are in retirement. The risks in investment risks more so in particular, and the types of strategies that we use to overcome those risks and to help construct a portfolio that is safe and meets the requirements of an investor's goals and income needs, all that sort of stuff. So very quickly, how to manage your wealth, just to show you the different 5 risks. First of all, when you're approaching retirement and progressing through retirement, investing risk becomes even more important as opposed to those who are just building wealth and accumulating wealth. So what are the risks? The number one is the market risk, which simply put, that's investing too much in growth assets. And if there's a downturn, then you're going to lose too much than what you should have lost. Second one is longevity risk. That means running out of money. You outliving your money, so not investing enough into growth assets, so your super or capital keeps growing. Third one is inflation risk. That's where you want the income that's getting paid to you. You want that to keep rising steadily each year. So as expenses rise around you, your income keeps rising. So you need to manage that appropriately. Fourth one is liquidity. To give you an example, people who might have their superannuation all invested in property, you can't exactly just go off and sell a bathroom if you want to access 20 grand to go on holiday or upgrade your car or for medical costs, something like that. You need to have a nice liquid portfolio. The fifth one is sequencing risk. And what that means is depending on when you start drawing down money, you want to make sure that it's handled properly, especially in bad market conditions when there might be a share or property market downturn. So we want to make sure everyone's having a nice, prosperous, fun retirement. To give you an example, we've got 2 investors here, Investor A and Investor B. They both start with $350,000. And the returns, both average out 5%. Investor A's returns, see here at the start, 3, -25, -10, 4. Investor B gets the exact same returns, but in reverse order. So 3, -25, -10, 4, and all the way up to 14. And see. So you see how it's reverse order. And there's no withdrawals happening from this portfolio. So what that means is at the end of the 11 years, there's no difference between the portfolios. So there's no risk there. But when you start making withdrawals from the portfolio, see here we've got $25,000 being withdrawn to fund retirement in your retirement. Both the same portfolios. So Investor A is getting the bad returns at the start, the negatives. Investor B is getting those bad returns at the end. And what that means is Investor A, who had the bad returns at the start, has $92,890 left after 11 years. So they're quickly running out of money. Whereas Investor B has $260,000 after 11 years. So they're managing their capital much better. So that's the risk if you cop the bad returns at the very start. So we don't want that to happen. So one way to help manage that risk is to set up these 3 buckets that I have here. Short-term needs, medium-term, and long-term. Now, with the short-term bucket, we're going to invest 12 months of income in there. So take this example up here. This portfolio requires $25,000 per year to be paid out to fund living costs. So we're going to put $25,000 in this first bucket here, short-term needs, and mainly invested in cash. The medium-term needs, the second bucket, we're going to have 3 or 4 years of income stored in there. So somewhere between 75 to 100 grand put in there. Invested once again in safe assets, cash, term deposits, and bonds. So because all that money in those 2 buckets are invested in safe assets, it's very safe to say we've got 5 years of income stored away that's always going to be there. You can't lose any. There's no market risk attached to it. You can't lose any of that money. And the remainder of the money goes into the third bucket. This is the long-term needs bucket. And the majority of this goes into growth assets, which is shares and property. And because we've got 5 years of income stored away, we don't need to touch this third bucket for at least 5 years. So if there is a market correction, we can continue to spend the money in the short-term, medium-term bucket, which is conservatively invested, whilst the long-term bucket, which is full of growth assets, has the opportunity to rebound and recover. So to give you some examples of some years when this strategy would have been put to use, back in 1940 is the first one. There was a share market downturn, 23.8%, and the share market took 1.4 years to recover. So that third bucket would have had plenty of time to recover, didn't need to be touched, whilst the income needs would continue to be met from these first two buckets. 1964, negative 20%, 2.1 years to recover. There's a few more examples there, but the worst one to take into account of all that, where it took the longest to recover, was the one fresh in our memories, 2008, where the market dipped to 51.4%. It took 4.6 years to recover. So if we take the worst possible situation out of history over the last 80 odd years, this strategy is going to allow plenty of time for those growth assets to recover. And you don't have to be selling down growth assets in bad times. And when you're selling down growth assets in bad times, that goes a long way to you running out of money. So hopefully that's been some help and some assistance, something to think about. Have a good day. See ya.